Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, March 18, 2025. Hope you're having a fantastical day out there in the interwebs. It's a day here. It's kind of overcast. I think we're going to get a little snow tonight, which that's always exciting. Maybe not, but it's going to be cold and kind of dreary today and tomorrow. So anyways, hope you're having a great day out there. Markets are sliding again with the SP down about 1%, the Dow off 0.85%, and the NASDAQ sinking 1.78% as trade war fears rattle investors. Trump's move to double tariffs on Canadian steel and aluminum to 50% is fueling market jitters. While tech stocks are taking a beating, Tesla is down 4.6%, and Alphabet is slipping after its $32 billion cybersecurity acquisition. Meanwhile, all eyes are on the Federal Reserve's two-day meeting, with investors bracing for any hints about future rate moves. Here's a newsflash. I bet they don't do anything. So but before we break it all down, I need some help from you. If you can give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All righty, well, let's get into the markets. Dow Jones today was down 0.62%, 260 points, closed at 41,581. S&P 500 down 1.04%, 58 points, closed at 56.16. NASDAQ down 1.71%, 304 points, closed at 17,504. The VIX up 6% today. It's at 2174. Canada down 0.32, Brazil up 0.56, and Mexico up 0.42. Headed to Europe, Germany was up 1.03%, the UK up 0.29%, France up 0.5%, Netherlands flat at 0%, Spain up 1.58%, Italy up 1.31%, Switzerland down 0.05%, and Portugal up 1.07%. Russian exchange is green today. MOEX up 0.28, RTSI up 3.73%. And the overnight markets, the Nikkei in Japan was up 1.2%, Australia up 0.08, New Zealand down 0.36. In China, the Shanghai was up 0.11, Shenzhen Component up 0.52, China A50 down a tenth, DJ Shanghai up 0.19, Hang Seng up 2.46, and the Taiwan weighted up 0.69%. Good stuff. All righty. So, all right, let's get to our, where is it? Here it is. There it is. Oop. Let's get to our market recap. S&P 500 slumps ahead of the Fed meeting. Nvidia conference set to begin. Get my notes here. Stocks, U.S. stocks fell on Tuesday as investors braced for the Federal Reserve's latest policy decision and Nvidia's highly anticipated GTC conference. Market uncertainty remains high, with concerns about inflation, economic growth, and geopolitical developments weighing on sentiment. So starting out with the Fed meeting, interest rates and economic projections are in focus. The Fed is widely expected to leave interest rates unchanged, though investors are eager for new economic projections that may signal future moves. Sticky inflation and labor market cooling could influence the central bank's stance. And the impact of Trump's economic policies remain a key unknown, adding to the uncertainty. Next up, the housing market, recovery with risks. A single-family home building jumped 11.4% in February to an annualized rate of 1.108 million units. However, rising construction costs, tariffs, and labor shortages threaten the recovery. And next up, the Trump-Putin call and geopolitical implications. Trump and Putin discussed a potential Ukrainian ceasefire, with both sides reporting a, quote, positive, end quote, conversation. A positive deal could lead to lifted sanctions on Russian energy, which may provide a boost to global markets. In corporate highlights, Nvidia CEO Jensen Huang will address AI's future at the company's GTC conference. Nvidia stock remains 20% below its January highs as AI hype faces market skepticism. Tesla shares fell over 4%, with the total monthly losses hitting 23%. RBC cut its price target, citing concerns over self-driving software. And lastly, Alphabet dropped 2% after announcing a $32 billion acquisition of cybersecurity firm Wiz. Final takeaway, markets are jittery, with the Fed, tech volatility, and geopolitical uncertainty creating a perfect storm. But hey, at least we can count on AI and government intervention to keep things interesting. Right, folks? All right. All righty. Let's jump to some data. February housing starts. This comes to us via First Trust and Mr. Nate Gurzy. So let's read through his report. After a weather and fire-driven slump in January, U.S. home construction rebounded sharply in February, hitting a 1.501 million annualized rate, exceeding even the most optimistic Bloomberg forecasts. Gains were broad-based, with both single-family and multifamily starts increasing across most regions. So supply challenges remain. Despite February's surge, housing starts are still down 2.9% year over year, while permits for new builds have dropped 6.8%. Builders appear focused on completing existing projects rather than breaking ground on new ones. Home completions fell 4% in February, but remain historically high, exceeding the 2020 to 2023 average. Total homes under construction have declined 14.8% in the past year, a rate typically seen during housing busts, though no such crash appears imminent. Housing shortages keep prices elevated. The U.S. has consistently underbuilt housing since 2007, with supply falling to meet demand. Despite economic uncertainties, housing prices are expected to rise in 2025 due to persistent shortages. Market sentiment and inflation data. The National Association of Home Builders Housing Index fell to 39 in March, signaling worsening builder confidence. Import prices rose 0.4% in February, while exports edged up 0.1%, contributing to broader inflationary pressures. The housing market isn't collapsing just yet; it's just chronically underbuilt. So much for that housing bubble narrative. All right, got a little more data here. Next up, February industrial production and capacity utilization, also from First Trust. Mr. Bryce Gill did this report. Alrighty, U.S. industrial production rose for the third consecutive month in February, surpassing expectations and reaching a new record high. A favorable business climate marked by regulatory rollbacks and lower corporate taxes is fueling growth, though trade uncertainties remain. Manufacturing gains despite trade concerns. The manufacturing sector grew by 0.9%, with auto production surging 8.5%. Given strong U.S.-Mexico trade ties in the auto sector, upcoming trade negotiations could bring on some volatility. Non-auto manufacturing, often viewed as the core of industrial production, rose 0.3%, maintaining a robust 6.2% annualized growth rate over the last 3 months. High-tech and energy sectors lead the charge. High-tech equipment production jumped 1.4%, driven by AI investments and semiconductor reshoring. Over the past year, high-tech manufacturing has soared 12.7%, making it the fastest growing category. Mining production increased by 2.8%, reflecting a boost in oil, gas, metals, and drilling activity. Expect further acceleration in 2025 as Trump's administration ramps up permitting. A weak spot is in utilities. The utility sector declined 2.5%, a predictable dip given its volatility and dependence on weather conditions. And finishing up here, regulatory relief and tax cuts are driving manufacturing growth, while tariffs remain the wild card. For now, the industrial sector looks like it's firing on all cylinders. So that's some good news out of the at least some of the sectors. All right, finishing up here, article from Zero Hedge: How Tariffs Will Lower the Cost of Living. This was written by Spencer Morris of American Greatness. So we've been hearing a lot of news about how the tariffs are just terrible, and I mean, in my mind, a tariff is just another tax. I mean, it's a tax on the good when it comes in, as opposed to a tax when you buy it. So, anyways, all right. Critics argue that tariffs drive inflation and harm consumers, but this ignores the broader economic impact. While there may be short-term price adjustments, tariffs are designed to incentivize domestic production, ultimately lowering costs in the long run. So how tariffs work to lower costs. Tariffs only apply to imports, making them an avoidable tax simply by American. Foreign producers seeking to access the U.S. market will be forced to lower costs to stay competitive. Increased domestic production benefits from economies of scale, reducing per unit costs over time, and higher input costs encourage innovation and automation, driving productivity and lowering prices. The real inflation problem is assets and debt. While critics obsess over consumer prices, they ignore housing inflation driven by foreign investment in U.S. real estate, $42 billion last year. Foreign ownership of American businesses, 17% of equities, leads to intellectual property theft and national security risk. And the U.S. trade deficit forces reliance on debt, with $8.67 trillion in foreign-owned treasury securities, inflating costs and adding $150 billion in annual interest payments. Reshoring industry and reviving the American dream. Tariffs redirect investment towards productive industries instead of financial speculation. By incentivizing domestic manufacturing, tariffs promote job creation, innovation, and long-term price stability. The real question isn't whether tariffs raise consumer prices. It's why policymakers favor asset inflation that benefits the wealthy over policies that rebuild American industry. Tariffs aren't just about trade. They're about restoring economic sovereignty. America can either build its future or buy it on credit from foreign powers. All right. Well, that is everything that I wanted to cover for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All your financial planning needs can be addressed there. So give me a call. I'd be happy to help. Hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.